There's a strange moment that appears again and again in history, a moment when public confidence is loudest and institutional behavior is quietest. It is the point where belief and action begin to diverge. Speeches become firmer, slogans more confident, enemies more clearly named, while beneath the surface, capital starts moving with an almost eerie calm. Most people only notice this moment in retrospect, once the outcome is already fixed. But if you slow down and look carefully, the signals are always there. Between 2018 and 2020, the United States was publicly locked in confrontation with China. Tariffs dominated headlines, supply chains were questioned, politicians spoke about sovereignty and industrial revival. To the average observer, this looked like resistance. But markets do not respond to speeches. They respond to incentives, probabilities, and time horizons. While the public debate framed the conflict as ideological or geopolitical, the financial system interpreted it as something else entirely. A shift in relative certainty. And certainty, not loyalty, is what capital seeks. Large institutions do not think in terms of nations the way populations do. They think in terms of systems. They ask which rules are becoming more predictable, which structures are being formalized, which risks are being socialized, and which rewards are being protected. During those same years of political confrontation, China was doing something far more important than negotiating tariffs. It was opening, standardizing, and internationalizing its financial markets in a way that made them legible to global capital. Quietly, methodically, it was offering the one thing large pools of money require above all else, a framework they could operate inside. This is not betrayal or conspiracy. It is behavior shaped by incentives. Financial institutions exist to survive regime changes, currency shifts, and political cycles. Their true loyalty is not to flags or ideologies, but to continuity. When a system begins to show signs of strain, the question they ask is not whether it will fail, but when the balance between risk and reward changes. And when that balance shifts, they do not announce their conclusions. They reposition. To understand why this happens so consistently, you have to step back from individual events and look at how belief sustains monetary systems. Every dominant currency rests on an invisible agreement between the state, the financial sector, and the population. The state promises stability and enforcement. The financial system promises liquidity and growth. The population accepts the currency as a store of value and unit of trust. As long as that triangle holds, the system feels permanent. But permanence is an illusion created by memory. No reserve currency has ever survived its own success. The pattern usually begins with discipline, limited money, constrained spending, and real productivity. Success follows, and success brings ambition. Governments discover they can promise more than they can tax. And financial institutions discover they can convert those promises into assets. Debt becomes not a burden, but a mechanism. It funds expansion, smooths political conflict, and postpones trade-offs. For a long time, this works. Growth masks fragility, confidence reinforces itself. The currency spreads beyond borders, and eventually the world begins to save in it. But scale changes the nature of the system. Once obligations grow faster than productive capacity, money stops representing value and starts representing time borrowed from the future. At first, this is subtle, then it accelerates. The state leans more heavily on monetary tools. Financial actors adapt. The population is reassured. And eventually, the currency's role shifts from anchor to instrument. It still circulates, but it no longer disciplines behavior. It enables it. At that point, the system has already crossed a line, even if no crisis is visible yet. Those closest to the machinery can see it, not because they are smarter, but because they are positioned where incentives change first. They notice when risk is being absorbed by the public balance sheet. They notice when political promises require permanent deficits. They notice when confidence is being maintained rhetorically rather than structurally. And when they notice these things, they do what the system trained them to do. They look for the next environment where the rules are tightening rather than loosening. This is why capital movements so often contradict political narratives. Politics speaks to belief, capital responds to structure. During periods of monetary strain, political conflict often intensifies, not because it causes the problem, but because it distracts from it. The arguments become louder precisely when the underlying constraints are weakest. Trade wars, culture wars, ideological standoffs all occupy attention, while financial integration continues along paths laid years earlier. China's appeal to global capital during this period was not ideological. It was procedural. Clearer market access, growing domestic savings, state-backed stability, and a long-term strategic horizon signaled something crucial: continuity under constraint. While the U.S. system appeared increasingly dependent on monetary expansion to preserve social and political equilibrium, China appeared willing to trade short-term inefficiency for long-term control. For institutions trained to think in decades, that difference mattered more than tariffs. None of this means outcomes are predetermined or that one system is morally superior. It means that money flows toward environments where future claims feel more enforceable than present ones. It means that when a dominant system begins to rely on belief rather than discipline, those who manage capital quietly hedge that belief. And it means that by the time public confidence finally breaks, the architecture of the next system is often already standing. The most uncomfortable part of this pattern is not the loss of dominance, but the delay in recognition. Populations experience monetary transitions as sudden shocks. Institutions experience them as long migrations. Inflation feels unexpected to those paid in currency. It feels inevitable to those who issue it. By the time the consequences become obvious, the choices that mattered have already been made. History does not repeat because people fail to learn. It repeats because incentives do not change. Systems built on expanding promises always reach a point where credibility costs more than control. When that happens, money moves before trust does. The public debates the surface while the foundation is being rebuilt elsewhere. The unsettling question is not whether this pattern is real, but whether recognizing it changes anything. Awareness does not stop structural forces, but it does alter how you interpret them. It shifts attention from drama to incentives, from rhetoric to architecture, from events to systems. And once you start looking there, history stops feeling random. If you want to explore more stories about money, power, and the systems that quietly shape them, you're welcome to subscribe.